Let's welcome in Stephen Englander, Managing Director, Global Head of G10 Forex Research and North American Macro Strategy at Standard Chartered Bank. Stephen, great to have you with us here. Thank you very much for your time. Prashant this side. So does what has happened with regards to courts stepping in now, and of course, I mean, for now, the appeals court has ruled in favor of the White House. But it kind of does show that the judiciary will step in as a bit of a guardrail in the U.S. Does it weaken, the White House's position negotiating tariffs with all its major trading partners? What's your sense, Stephen?
I think it weakens it a little bit. Certainly, the the trading partners who are facing very high reciprocal tariffs. It doesn't look as if that's as big a threat now as it might have been, say, a week ago. But even then, it looked more likely that they would just roll over the 10% baseline tariff rather than, jump to the reciprocal tariffs. They do have a bunch of options. And, if you actually read the decision of the court, it's a little bit narrower, I think, than was construed. The issues seem to be that there was no limit that the Trump administration saw on what they could do on tariffs, and the court was sort of saying the authority that Congress gave them is not meant to substitute for congressional discretion. So there has to be some sort of bound, congressional review or some time limit on it or something. So, but overall, I'd say that it's probably not great for the bond market because it may make it less likely that they get as much revenues as they anticipated. I don't think it's great for the dollar just because the uncertainty is back. Even if you're not a fan of tariffs, a world in which we're not sure if tariff on, tariff off is not a particularly good world either. So, it could be a little dollar negative, but not, I wouldn't see it as being a first order issue.
But on that, Stephen, hi, great to have you on the show. On that, let's talk more about the moves in the dollar. It's been on a gentle deceleration slope for the last several months since the onset of this year, right? Do you think we've made the lows for the year, or could it actually head lower if you believe, or the market believes, that indeed Mr. Trump will prevail one way or the other on his tariffs?
I don't think we've hit the lows, but I think you're right that we're not going to see a precipitous decline in the dollar. For one thing, I think the market participants are scared that, about the possibilities that the, tax bill works and the tariff works. And then in 6 months, the U.S. is looking like a strong economy. It may not be the baseline, but there's enough of a risk there. What we've said is actually that there's 2026 risk, that if the economy doesn't look strong, and the deficit does go up in the aftermath of the bill, we could see real pressure on the dollar then. But I think for now, the market is going to be doing cautious selling of the dollar rather than two-handed selling.
Hi, Stephen. Good morning. Good to see you, Ben. What are you factoring in terms of action from the Fed? We started the year expecting them to do a lot, but the way things are progressing, it's anyone's guess. According to you, how many cuts do we get this year?
We're still at 2 cuts. And I think that today's meeting with Trump kind of outlines the issues that the Fed is facing, that they can't afford to be wrong on this. And they certainly can't afford to be wrong, with a political motivation. They have to play it straight down the middle. And so I think that if, as we expect, the incoming data get weaker, I think they will cut. The weakness, say we have payrolls of 50,000 and a month from now minus 50,000 or something, or 6 weeks from now minus 50,000. It's not happening in a vacuum. All of the surveys are telling them, and their own surveys are telling them, that the economy is getting softer. So I think that they'll be relatively quick to cut. The issue that they face is that there hasn't been a single piece of hard data that really says you have to cut. But if they were to get those hard data, I think that they would cut, and they would cut relatively quickly. So I think the market may be too pessimistic on the Fed over the next couple of meetings. And by contrast, I don't see the late 2025 or 2026 cuts. We'll have the tax bill will probably be deficit increasing. I don't see what would motivate them to be cutting at that point.
And that's what they've been saying, right? That we will remain data dependent, and it will be incoming economic information that's going to guide, the shape and form of monetary policy. So let's see. Stephen, what about yields? At around 4.5%, have we seen the peak for now, or is there a further upside risk, especially because of this big, beautiful bill and the way the deficit is shaping up?
All of the above. I think in the short term, the market is quite short bonds. And that's why I think we saw such a dramatic move. It's not like there was big news today, but everybody had been selling. And as I said, I think that if the incoming data turn out to be soft and cuts, are put back in the picture in the next couple of Fed meetings, yields would come off. But ultimately, I think that the fiscal pressure is going to be there. And U.S. external debt has been growing as a share of GDP. The government deficit has been growing as a share of GDP. We're kind of more leveraged on the debt, both the internal debt and external debt picture than we were before. And I think that leaves us with some upside in terms of rates. We expect the 10-year to close the year closer to 5 than to 450.
It's a pleasure, Stephen. Thank you very much for joining us, and thank you indeed for being here with us today.